Hi, welcome to the another teaching video. In this video, we will be looking at the purpose of common size income statement. To study the change in individual line items of income statement and balance sheet. It allows determining how the various components of the income statement and the balance sheet affect a company's profile. That is a company's profit. The analysis helps an analyst or investor to understand the impact of each item in financial statement and its contribution to the resulting figure. The ratios tells investors and finance managers how the company is doing in terms of revenues, and they can make predictions of future revenues. The companies can also use these tools to analyze competitors to know the proportion of revenues that goes to advertising, research and development, and other essential expenses. It becomes easy to compare companies as the size doesn't matter. That is a cross-sectional analysis. It helps in time series analysis. It also highlights the difference in corporate strategies. The purpose of common size financial statement is to remove those financial differences between the companies that have nothing to do with their primary operations. Common size becomes useless if consistency is not maintained in accounting policies, concept, and convention. Say, for example, if a company following a depreciation, straight line depreciation means there must be consistent in following the straight line method. Suppose the company is following different accounting policies, like different depreciation method in a single accounting period, that is difficult to analyze. So there must be a consistency in following the accounting policies and concept and conventions. Common size is based on the historical data, therefore it doesn't recognize changes in price level. Window dressing is very common in the financial statement. The common size statement does not address the issue of window dressing. The common size statement does not give the importance to qualitative elements of income, only the quantitative. The common size statement does not ascertain the current ratio, liquidity ratio, debt equity ratio, capital ratios, capital gearing ratio, which are very useful in testing the liquidity and the solvency position of a firm. Although the common size analysis is not as detailed as trend analysis using ratios. In a simple way for financial managers to analyze financial statements. How to prepare the common size statement? The common size analysis can be conducted in two ways, that is vertical analysis and horizontal analysis. Vertical analysis refers to the analysis of specific line items in relation to a base items within the same financial period. For example, in the balance sheet, we can assess the proportion of inventory by dividing the inventory line using a total assets as the base item. On the other hand, horizontal analysis refers to the analysis of specific line items and comparing them to a similar line item in the in the subsequent financial period. Analyze common size income statement. Excuse me. Compare the margins over the period and see if there is a trend or unusual spike or a dip. Ideally, we would hope to see a stable and gradual growth. The comparison of margins over the period should indicate the performance of the company. The margins we should have are gross profit margin, EBITDA margins, earnings before interest, tax, and depreciation and amortization, earnings before interest and tax, EBIT margin, or net profit margin. How to interpret the statement, that is the common size statement? Go through the line by line from top to bottom, spending more time on the bigger numbers as they would have contributed to the margins more significantly, and identify the items that contributed to a deteriorations in margins or an increase in margins. Thank you.